Okay, so welcome to this session. I would like to look at one question here. It's a past paper question, and this question involves several elements. Involves something on margin of safety, which is something on break-even analysis or CVP analysis. And then there's something to do with division performance. And then there are also some questions here on other elements. So we just want to see what exactly the examiner was interested in this question. And we see how best you could be able to respond to it. So the question says that Shahi Millers and Bakers Limited, CMBL, based in Kisolo district, was founded by Mr. Sezonga Max in the early 20s. CMBL has wheat milling division and bakery division that produce wheat flour and bread respectively for both local and outside market. Both divisions are profit centers headed by managers. Now, as I do proceed, as read through this question, you're able to see something, because when we read down here, there's something to do with divisional performance, managerial performance. So you know that this, where this topic really falls, okay? So, and we are seeing divisions coming to play here. So there are two divisions, as we can see, that are producing wheat flour and bread respectively for both local and outside market. So both divisions are profit centers headed by managers. Now, right now, the word profit center should be something that doesn't sound to be new to you, because we know that organizations can have divisions that can be either be cost centers, they can be revenue centers, or can be profit centers, or can be investment centers. And if a division is a profit center, means that they basically they have control over revenue and the costs. If a division is a cost center, its focus is only on the cost. Its control is only on the cost. So that is what is happening here. So these divisions, the managers have control over costs and revenues, because profit is revenue minus costs. So they're telling us that the new general manager decided to measure the divisional managerial performance using both return on investment and net profit based on controllability principle. Again, return on investment, this is also very familiar to us when we're looking at division performance measurement. Net profit is also very common, and then they're bringing an aspect of controllability principle. Whenever we have managers that are overseeing divisions, there's what we call controllable profit. There's what we call controllable profit. So controllable profit in this perspective is looking at the revenue minus the controllable, the costs that we can control, okay? And we will be able to see that as we proceed. So they're telling us that she also wants the new manager, she also wants management audits to be conducted on a quarterly basis. Again, another new term there, to ensure efficient implementation of the next 5 years strategic plan. Similarly, CMBL's margin of safety will be tested on a quarterly basis for continuous profitability monitoring. CMBL sells wheat flour and bread in the sales mix of 3:2. Current liabilities for the milling and bakery divisions as at 31st December were 8,164.8 million and shillings 94 9,458.64 million respectively. The authority to borrow and acquire capital assets is centralized. The weighted average cost is 18%. Now, when you see this weighted average cost of capital being provided, then something should come to your mind on where am I actually going to use this weighted average cost of capital. And then they're telling you that below is the financial information extract for the year ended 2021. So they are giving us milling division, bakery division. So they're giving us sales output, sales price per kg, variable cost per kg, fixed cost in millions, total assets in millions, total liabilities in millions for the financial year ended 2021. Then fixed costs include the following: depreciation, interest expense, bad debts expense, headquarter expense. Now, as you can see, these costs are all included. They are basically included within the so-called fixed costs. Now, you must be asking yourself why the examiner's gone ahead to give you this information, okay? Now, this is where the controllability will come in, because the examiner is telling you that part of the fixed costs include some costs that you need to be aware that the manager may not have control over. Now, for those that may not be familiar of how divisions work, or branches work, if you have a bank branch, or if you have bank branches, you'll find that if they are considered as profit centers, definitely they generate revenue, but they also handle costs, especially costs for, let's say, rent, the staff that work in that branch, their salaries, cleaning costs, and so on. Operational costs, basically. But then there are also costs that are charged from the head office. Why? Because the head office, you know very well that the head office does not make revenue in most cases. The head office is a controlling office as per se. So it doesn't make revenue. So in that case, there are some costs that are coming from the head office. So what happens? Do you have control over those costs? Now that is where the aspect of controllability actually comes into play. So we are going to see. So the first question here the examiner is asking us is to advise management on the company's margin of safety in shillings. Now, I hope you remember margin of safety is coming from the break-even analysis. Now, we have what we call a break-even point. And by break-even point, we could have a break-even quantity. Let's say if an entity deals okay, let's say bread, it will have a quantity of bread that at that quantity or beyond that quantity, the company starts making profits. Okay, we know that at break even, the profit is zero because your total revenues are equal to your total costs. You're just breaking even. You're neither making profits, you're either not making losses. Okay, it's just at break even, zero. So from break even, the company now starts making profits. So if your break even, let's say, was 10 units as a company, if you're making, let's say, 20 units, means you're above your break even of 10. You're making 20, you're above your break even of 10. So what does that mean? That means that you have some safety net between your break even and at a point in time where you are producing at. Now, the distance between where you are at and your break even point is what is regarded to as your margin of safety. And margin of safety could either be in terms of quantities, but it could also be in terms of revenue. Okay, it could be just like the way break even is. Break even, we can have break even quantity, but we could also have break even revenue. So when the examiner asks us and says to advise CMBL's management on company's margin of safety in shillings, this whatever this is telling us is that we have to determine the break-even point, because you cannot determine the margin of safety for an entity without knowing their break-even point. And once we know their break-even point, we should now also look at where are they? What is their current sales? Okay, what is their current sales? And what's the distance between the sales and their break-even point? Okay. Now, this question has a company that is producing more than one product. Now, generically, we know very well that if it was one product, it was going to be very easy. Okay, it was going to be very easy. We've done the break even for a single product, and right now it should be easier for you. So if you do remember very well, like I said, at break even, our total revenue is equal to the total costs. That is generic. And we say that total revenue, if we're calling it TR, is given by price times quantity. Well, our total cost is given by the variable cost per unit times quantity plus the fixed cost, which I'll call FC. So it means that at break even, the so-called PQ is equal to VC that. And we say that if we are to arrange this, we'll just have something like this. We'll just pick this VC2 here and bring it this side. So this side it will go away. So it means that if you're to make your quantity the subject, this will equal to FC, which are your fixed costs, divided by price minus VC2. And this alone gives us our break-even quantity formula, which says that it should have fixed costs but now these ones will be divided by price minus VC, which is called contribution. per unit. Now, this is for a single product where a business is dealing in a single product. But if you're dealing in a multi-product, this formula will change, okay? This formula will definitely change. So what we are going to basically have is our break-even quantity, okay, will equal to fixed costs. But instead this time, instead of dividing our fixed costs by the so-called, instead of dividing our fixed costs by what we are dividing currently, which is our contribution, okay? This time, what we do is we divide by something called weighted average contribution per unit. We divide by what is called weighted average contribution per unit. So here, instead of contribution per unit, we shall have weighted average contribution per unit. Why we call it weighted average contribution per unit is because it includes more than one product. So instead of just us looking at the contribution per unit for a single product, we look at the two products, but then we weight average them, okay? We do weight average them. So what that means is that if you have the question that we have at hand, then we have to weight average the bread with, I think, the wheat flour, okay, that we have at hand. So, like I said, because the examiner asks for margin of safety, we have to actually go on to calculate the break-even point before we can get the margin of safety. So what that means is, what I'm going to basically do is I'm just going to draw a table here where I'm going to have my products. Remember, we have the bread as products, and then we have the wheat flour. Okay, sorry, let's just. So, so what we are going to do, they have given us this information, okay? Of course, we know very well that if they say milling division, this definitely relates to our so-called wheat flour. Well, when they say baking, they are speaking about bread based on the earlier information that we actually got, okay? So the information is the same. So if the information is the same, I want now to just copy this. Now, why I'm copying that information is because it is the information that does provides to me. Okay, it's not copying very well here, but it's the information that gives me what I would say the contribution. Like you've seen that it's very important for us to determine the contribution before you can determine the break-even quantity, okay? So contribution is usually the selling price, minus the variable costs. So that is what I want to leverage on. So I have my sales output. Okay, just trying to complete my information here from the exam, from what I have, okay? From what I basically do have. All right. So this is what I have. That is what I basically do have. Now, it's quite important that we know that, like I said, if we are to determine our contribution, then we have to leverage on the selling price and the variable costs, which information we now have right here. So if we do have that information, now it's just a we're just going to do a simple, yeah, you can be able to leverage on your calculator and so on. Now, it's a contribution per unit. So contribution per unit, if I have my selling price at this value, and I less my variable cost, this, I get 900. And if I do the same here, I get 1,500. I also have a total here for total. Yes, for us to get our totals there. Now, after I've determined the contribution per unit for each of the products, now I just want to bring in the aspect of how do we calculate the weighted average. Now, why I'm doing all this is because we've agreed that for me to calculate my so-called break even, okay, I have to do fixed costs divided by my weighted average contribution per unit. So fixed cost is usually provided, and even in the question we are provided with it. So that's why I'm doing the weighted average contribution per unit. So for me to calculate the weighted average contribution per unit, I need to go back and find what I'll call the sales mix. So when I come here, they told me that the sales mix is 3:2. So I'll just bring that here. Sales mix. Okay, just say 3. Okay. 3:2. That is what I basically have. Now, once I have my sales mix, okay? Once I have my sales mix, I now have to determine what I'm going to regard as my weighted average contribution per kilogram. My weighted average contribution per unit in kilograms is going to be like this. I want you to just watch here. Now, this is my sales mix, okay? Which they have given me to be at 3:2 as provided. But for me to determine the weighted average, I have to basically get the ratio, okay? This is sales mix. So I'll just try to get a sales mix ratio here. I could even try with this. Just say this is 3:2. Now, the ratio that is going to be here, remember what we do with the ratios? We get what is for bread, let's say is 3, and divide it by the total ratio. In case I want to get what the composition of bread. So 3 divided by 5, which is the total ratio of 3 plus 2. So gets me to 0.6. And then for wheat flour is 2 divided by 5, which gets me to 0.46. So in case I'm trying to get my so-called weighted average contribution, I'm going to get this multiplied by that. Now, this will give me 540. This will give me 600. Okay. And in case I want to get my total of this, gives me about 144 that. Okay. I hope you're watching. Now, what I have gotten is, as you can see right there, is going to help me determine my break even. It's going to determine my break even, but I cannot determine my break even unless I have the fixed costs. So the fixed costs, I'll just go back to the question. When you go back to the question here, the examiner provided us with fixed costs. So they told us that the fixed costs for each of the department is as provided. So I'll just move the same right here. So these ones are in millions. What I'll just do, I'll just allow me, I think, add the 6 zeros. 1, 2, 3, 4, 5, 6. One, 2, 3, 4, 5, 6. Okay. The total of this is 30,153. Okay. So let's now determine our break even. quantity. Now, our break-even quantity is going to be determined by this. Look at this. You get, remember, we look at this break-even quantity first from the whole. So the total fixed costs is 30. So 30, 153 divided by our weighted average contribution per unit. And this gives us 26,450. So this break-even quantity is in kgs. These are units. Is in kgs. Now this is overall. This is overall. But in case I wanted to know, because in case I wanted to know now in terms of kgs for each of these, what I'll do, I'll still apply my ratio. So means that 26, if I want to determine here, to be 26 times what? The 0.4. And what this is also going to be, is going to be still the 26 that I've gotten multiplied by the 0.6, which is getting me those values. This is the break-even quantity. So what it means here is that we need 15,870,000 kilograms for bread and 10,580,000 kgs of wheat flour for us to break even. Okay, for us to break even. Now, the 26 may not easily make sense because it's a mix, it's a category mix of wheat flour and bread. But this is able to give you when you now bring it specifically to products. Okay, when you bring it specifically to products. So if that is also the case, now here, what we shall now proceed to is ask ourselves, what about if we wanted to determine the break even now in shillings? Okay, and this is our break even revenue. Now, you know very well that if you have sales, if you have the quantity and you have the price, you can determine the revenue. So to be as simple as getting the 15 multiplied by the selling price. So this will be the same across. Even this will be selling price times that, you get your 47. And definitely you can be able to get your total. We will not do the same for here because it's we don't have like a single price. Okay, so that gives us 101,568. Now this is the break-even revenue. Remember what we said with margin of safety? Margin of safety is the difference between our where we are, which is our current sales revenue or quantity, and what is our break even. So the next thing is for us to just appreciate what are the sales, what is the sales revenue, like the current sales revenue for the period that we are looking at. Now this sales revenue, definitely they have given us information about the sales units, the sales output, and they have also given us the sales price. So it's as you getting this value, the sales units multiplied by the selling price, which gives us 833, and cascaded down, that gives us that. And in terms of total, it gives me about, let me, okay, just a moment. Let's just confirm that these figures are in thousands. What we have, it's important to confirm the degree of precision. Okay, is in tons. Thank you. So this is in tons. So if this is a selling price per kg, means that we have to multiply by 3 since this is in tons. Okay, so means that in addition to this, we'll just have 1,000 on it. This will also be times 1,000. Yeah, we're just doing that because this is in tons. But if in case it didn't have tons, that would have, if it had kgs, that is how it would be. But because it has tons, and how I've been able to also detect that is the figure that we got compared to our break even. Of course, if your margin of safety only happens when you're above your break even point. If you be below your break even point, there's no even safety to look at. You're not safe. So usually when you're calculating your margin of safety, your current position will be higher than your break even. Okay. So that is important. So our margin of safety definitely here is just comparing two values. Will be to compare this, which is our current sales revenue, and this. So it's giving me 29 there, and then overall for the company, it's giving me 57,322. So this is what basically my margin of safety that the examiner asked about here in this question down here to calculate the margin of safety in shillings for the entity. Now they're saying advise management on the margin of safety. You see how the questions are. Now one thing that you also need to note, especially for the examiner, is the formula for margin of safety. Okay, because the examiner might be wondering how you got margin of safety. So it's very important to just put the formula aside. Yes, and say that this is current, your current sales revenue minus your break even revenue. So that's important. So you can just conclude and say, what was the name of the company? CMBL's. CMBL's margin of safety is at 57,322, which implies that if it falls, if its revenue falls by 57,322, then they will go below the break-even point and start making losses. Okay, so you just do the interpretation from your basis of understanding what break-even is basically. So this question also had a part 2 that I just want also to comment about. So the question was asking us to assess the divisional managerial performance using both net profit and return on investment. Now, usually in divisions, people think that if branch A is doing more profits than the other, then automatically branch A is actually better than the other, okay? But as we see that we have different other models of evaluating divisions, like the way we have the return on investment, then it's able to tell us more. Because you see, a division may be making more profit, but when there is a huge amount of money that has been invested, you know, you cannot compare a division where they have invested 100 million and the division where they have invested 2 million. If a division where they have invested 2 million is making 1 million, and a division where they have invested 100 million is making 5 million, you cannot say that the one that is making 5 million is actually better off. Because when you look at now how much has been invested into such an entity vis-a-vis how much is coming through, you actually realize that there is under capital utilization. There is basically underperformance for one division compared to the other. So that is why it is important to now use this concept of return on investment. So we want to just look at the two. Now, what you're going to basically do in this case for you to approach this question is they have already given us some information here. They have given us the selling price, the sales output, which gives us an understanding of what the sales revenue is. Now, the other thing that we also we should be able to have is we can calculate the net profit, definitely, because they have given us the variable costs. They have also given us the fixed costs. So we have the total cost, we have the total revenue, but they have also given us what they are calling the fixed costs that are included in there, some of which will help us to handle the aspect of controllability. Because they are telling us that one of the aspects that the new manager wants to bring in is the aspect of controllability. Now, if you remember, when we are looking at return on investment, it's basically profit divided by capital employed. So the examiner has also gone ahead to give us the weighted average cost of capital, but they've also given us information on the total assets and total liabilities. So we can be able to determine our capital employed, okay? Capital employed is, we know capital employed. Capital employed basically is looking at, is like your equity, okay? Is just like your equity. So you're trying to look at what are your assets, what are your liabilities, and then you're able to get the two values together. So let's just try this out and see what exactly you needed to be doing. So what you, since we are now also comparing divisions, what we are going to do in this case, the other case we looked at products. So here we're going to have a table with just like these two things, division, baking division, and then so we are going to do more of a profit statement. Look at the revenues and then look at the different aspects of the costs. So we already have, allow me copy this information. The sales output, which is in tons. So this is the sales output, and they also gave us the selling price. The selling price, which we have. But what I'll do is, so just copy this here. Same information, because it still relates to the same thing. Remember, we already got what you would call our contribution. And we say that contribution per kg is given by this minus this. So that is what we had. Now, in this case, since this is a profit statement, we are going to calculate the total contribution, okay? We're going to calculate the total contribution. Total contribution. So total contribution will just be this times the output, the kgs, okay? So 900 times this times 1,000. Because we said that they are in tons, so it's very important. So I'll do the same thing for this as well. The contribution times this times 1,000. So that is what I basically have. So that's the total contribution. We're building our profit statement, okay? We are basically building a profit statement. You can be able to, alternatively, you could also look at, you could do total costs, total variable cost, and total revenue, and then get it.
Just remind me here, why are you multiplying by 1,000?
Because this is in tons. And remember, we're doing total contribution per unit is per kg. So if you have to get something.
Okay. Got it, that's fine.
Okay. Okay, so total contribution. That's I was saying that you can also get your total sales, total sales revenue minus total variable costs. You should be able to come to the same thing as an approach as well. So once we've gotten our total contribution, we need now to look at the fixed costs, because remember, we are working towards determining our profit. And in this case, we want to determine our controllable profit. Okay. Now, when we are doing that, in this case, we have to separate our controllable fixed costs from the total fixed costs. You remember what the examiner gave us? The examiner gave us this fixed cost amount. And then they also gave us some costs here that we are going to make decisions on. Now, it's very important that here we are saying controllable fixed costs. So the controllable fixed costs, we are going to get these fixed costs that we have here and remove any fixed costs that the manager doesn't have control over. A division manager wouldn't have control over. Okay. Now, when we are looking at controllability, we look at different aspects. We look at different aspects, and partly what we are looking at here, as you can see, like I told you of what controllability means. We want to make sure that we only leave those costs that the manager has control over, or whatever you're responsible for. Now, in terms of these costs, when you see depreciation, these are notional, we call them notional costs. And usually these percentages could be set by the head office and say the depreciation percentage is this percentage. Okay. This is one. Now we have interest expense. Now interest expense, this is also usually like an allocated cost. It's like the head office took a loan and the loan is shared across the different branches. Then we have the bad debts expense. Now, a question you should ask yourself, is the bad debts expense a cost that is under our control? Bad debts are usually as a result of your accounts receivable. So, do you have control over your bad debts expense? I would say yes, because since you're a profit center and you generate revenue, then you are responsible for the bad debts expense. The headquarter expenses, do you have control over them? These are headquarter expenses that you basically don't have control over. So what we are going to do, we're just going to have a working. We can just create a working. I'll just stay working here. Now in the working, I just want to recompute what my controllable fixed costs are. That is my intention. And I'm going to look at still the two divisions. That is milling and the bakery division. Those are my two divisions that I'm looking at. Now, my first look is on what are the fixed costs that I was provided with. Now, just remove them here. These are my fixed costs. So those are the fixed costs that I do have. Now, the examiner has also given me fixed costs, some fixed costs that I don't have control over. So I'll say less fixed costs out of control. Oh, okay, you can say fixed costs not controlled by the division managers. Now, those fixed costs are these ones that we've been able to highlight. Now, what I'm going to do is I'm going to copy one by one. So I have depreciation. One, two, three. 2, 3. Is it in millions? Let me just try to confirm. So they're also in millions. I'm going to add the other next 3 zeros. Let me first take interest expense as well. So I'm going to add 1, 2, 3. 1, 2, 3. 1, 2, 3. 4, 5, 6. 3, 4, 5, 6. Okay, I'm good to go. Then I'm going to leave out bad debt expense since we have control over that. And then come and one, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. Okay. So this is what I basically have. So if that is what I have, okay. Sorry, I think I needed not add this some 3 zeros. They are in thousands, not millions. They are becoming higher than the fixed costs themselves. So what this means, I can just get totals of this. So this gives me that. So now, if I'm to get my controllable fixed costs, I'm just going to get the difference. You can put them in brackets. But this minus that gives me 11. Cut across here gives me 14. So these are my controllable fixed costs. So I'll just pick these figures and take them to where? To my calculation here. And when I bring them here, I should be able to determine what I'm going to call my controllable profit. Controllable profit, which will be this minus this. We know very well that when you get contribution and less fixed costs, you get your net profit, or you get profit. So this other side, with the total contribution here. Sorry, this is picking a wrong value. This should be 1,500. I just dragged here and it was picking a 900. So this is 22,200, giving us these values here, our controllable profit. Now, why we are taking this direction is because they have talked about return on investment. Okay. Now, in the same way, the examiner has also told us that they are looking forward to using what they call the controllability principle, where we only look at the profit controlled by the managers. Now, the generic formula for return on investment is given by profit before tax, divided by our capital employed. And this whole thing is multiplied by 100%. So you've gotten your profits. Okay. You want to determine what is your capital employed. What is your capital employed, so that it can help you to determine your so-called ROI or return on investment. Now, from the information that they have provided us, you can try to determine your so-called capital employed. Now, what we are going to do is the examiner has given us this information. Okay. It has given us that information. They have also given us this information of current liabilities. Now, capital employed, sometimes I would bring it by, we know very well, we know what we call the asset equation, the accounting equation, which says that assets is given by equity plus liabilities. Now, in this equation, it can be expounded more, where we now go ahead to look at current assets and non-current assets, and then equity as well, and then liabilities are also broken down. Now, whenever we are trying to look at capital employed, we have, of course, we have different formulas, okay? We do have different formulas, but for our case, for you just to understand that capital employed, organizations deploy capital in terms of long-term loans, okay, let's call it non-current liabilities, where they say borrow, and or equity. They can also have equity. So capital employed can be given by non-current assets plus equity. Non-current liabilities, sorry, plus equity. Now, the same capital employed from your asset from the accounting formula, you can also say that this is given as your total current assets less your current liabilities. So we're going to use this since this is the information we have. So under your working, what we shall do, I'll pick this. Then I also just pick my current assets, my current liability, sorry. This is for so these values are all in millions. And what am I trying to calculate is capital employed. So these are total current liabilities, which will be this minus that. So gives us 5432, and here gives me 630 that. So I'll just pick that information. Okay, this is capital employed. So I'll just pick it and bring it here. Sorry, have I copied the right information? I'll just add my, since they're in millions, 1, 2, 3, 4, 5, 6. Then this one, remove that 1, 2, 3, 4, 5, 6. Yes, I think that is it. So my return on investment is going to be this profit divided by this time was 100. Are you able to get what I'm getting? Let's see if it can give me the, okay. Can give me the percentage. Okay, it's true. So let me just try to put this here. So this is in percentage. So I get 20% here, then I get I do get 17.5%. So what this means, we've tried to get the return on investment. But whenever we get to the return on investment, we have something that the examiner has given us. They have given us the weighted average. They have given us the weighted average, which is 18%, which is 18%. Now, if you are doing business and you incur 18% on getting source of funding, you would want to disqualify anything that gives you you're done? Huh? Yeah, no, it's okay. Let me close. It's fine. Okay. So the 18% that we've gotten here is actually what they were given. When you compare it with the 17, you actually realize that the 17.50 is actually lower. So the projects that the division that is working well is the one that is giving you 20. But you see, if you have to compare these two projects or divisions on controllable profit, you realize that it is the bakery division that would be working better. So you can see that if you use controllable profit, you'll make a different decision. And if you're using return on investment, it will be a different decision. So it's just very important that you appreciate the two methods. So you just provide the examiner with an assessment of using the two approaches. That is what basically was required of you, to just assess using both net profits and return on investment. Okay, so thanks so much. I would like to end this class here. In case you have a question, please drop it on the WhatsApp group. I'll be able to answer it accordingly. Thank you and have a good evening. Bye.